focus upon business performance and cash flows. The process to separate Tata Steel Netherlands and Tata Steel UK is currently underway, and our Aberdeen plant is amongst the most environmentally efficient and cost-competitive steel producers in Europe. Tata Steel is committed to running its operations in a sustainable manner and improving its disclosure on climate standards. We are taking multiple initiatives to adopt best available technologies for decarbonization and water neutrality. We are also increasing our efforts towards ensuring a responsive supply chain while fostering a circular economy and developing environmentally sustainable products. Our operations in India and Europe have been rated A- by CDP in their 2020 review. We are progressing in the reorganization of our Indian subsidiaries into 4 verticals to drive scale, synergies, and simplification. TSBSL, which is Tata Steel Bhushan, merger into Tata Steel is ongoing, and the merger process of Tata Metallics and ISWP into Tata Steel Long Products is also progressing well. I will now hand it over to Kaushik to comment on our financial performance.
Thank you, Naren, and good afternoon to all of you. I'm happy to say that this quarter, Tata Steel has delivered a very strong financial performance. We have delivered the highest ever consolidated EBITDA, supported by highest ever EBITDA at Tata Steel Standalone, Tata Steel BSL, and Tata Steel Long Products as well. I would like to remind you that our financial numbers do not include Southeast Asia operations as they continue to be held as assets held for sale. Our consolidated revenue increased during the quarter by about 7% quarter-on-quarter and 11% year-on-year to 39,594 crores. Our consolidated EBITDA grew by about 53% quarter-on-quarter and 161% year-on-year to 9,540 crores, with strong underlying performance in India. Our India operations, which includes the Tata Steel Standalone, Tata Steel BSL, and Tata Steel LP, generated revenues of 25,211 crores, which translates to a 9% quarter-on-quarter growth and 18% year-on-year growth. We achieved an EBITDA of 8,811 crores this quarter, driven by higher prices, better product mix in the domestic market, lower exports, and operating efficiency initiatives. This translated into an EBITDA per ton of 18,931 and EBITDA margin of 34.9%. Tata Steel Standalone revenues improved 10% quarter-on-quarter and 18% year-on-year to 17,966 crores. EBITDA grew by 43% quarter-on-quarter and 78% year-on-year to 6,737 crores, which translates into an EBITDA margin of 37.5% and EBITDA per ton of 20,175. Standalone operations generated free cash flow of about 11,381 crores in the third quarter. Our key subsidiaries, Tata Steel BSL and Tata Steel Long Products, have also delivered strong operating performance. Tata Steel BSL generated an EBITDA of 1,634 crores, which translates into an EBITDA per ton of about 14,223, while Tata Steel Long Products generated an EBITDA of 440 crores, which translates into an EBITDA per ton of 26,471. Both entities generated positive free cash flows of more than 1,750 crores and 600 crores respectively. Our other Indian subsidiaries like Tata Metallics and Tinplate Company of India and other downstream subsidiaries also reported strong results and a combined EBITDA increasing by about 19% quarter-on-quarter to 307 crores. Moving to Europe, our revenues increased by 3% quarter-on-quarter to about £1.44 billion in the third quarter, with higher steel prices partly offset by lower deliveries. The reported EBITDA loss for the quarter stood at £74 million. However, underlying performance was much stronger. It was impacted by one-off items, which I will explain now. As you know, the European governments have been running wage support scheme in the pandemic, but they are subject to certain conditions. In first quarter 21, Tata Steel Europe had recognized about 49 million of wage support under the Netherlands government scheme Now 1, which was received. In second quarter of the current financial year, Tata Steel Europe had similarly recognized 45 million wage support, including 38 million pounds from Now 2. The support was subject to satisfying multiple criteria and conditions. With the increase in steel prices, Tata Steel Europe realized it may be difficult to hold back the revenues, and actual revenues decline is lower than the qualifying threshold of 20% decline. Moreover, some of the conditions stipulated were onerous and restrictive, and hence this has been reversed. We have also made a provision of 110 million pounds for the CO2 emission rights in the third quarter with the increase in CO2 pricing. This includes 74 million due to the reversal of one-off gains recognized in the first quarter FY21. The strong operating performance combined with aggressive liquidity management has generated free cash flow of more than 12,000 crores during the quarter and about 20,500 crores during the 9-month period. While we had a target of deleveraging by about $1 billion every year, we have used this improvement in operating performance to aggressively accelerate our deleveraging. This quarter, we reduced our gross debt by about 5,640 crores and our net debt by about 10,325 crores by prepaying across Tata Steel Standalone, Tata Steel BSL and TSLP, and also our offshore entities. As you can see from as of December 31st, 2020, we are sitting on a fairly large cash balance of 22,000 plus crores. This is because we have additional deleveraging planned in the fourth quarter. We will further reduce the gross debt by more than 12,000 in the fourth quarter. We repaid about 6,400 crores till date in this quarter. Our liquidity position will normalize by about March 21. We have also been very disciplined on capex spend this year. Group-wide spend on capex this quarter was about 1,394 crores, which makes it to about 4,600 crores in the first 9 months of this financial year. Given the sharp deleveraging that has been achieved, we have decided to restart work on our pellet plant and cold rolling mill complex in Tata Steel Kalinganagar. And as Naren mentioned, we hope to complete it in the next 12 months or so. Our consolidated capex for this quarter would be in the zone of around 1,800 to 2,000 crores. I would like to emphasize that we are strongly committed to our deleveraging plan of $1 billion per annum and focus on the capex spend in financial year 22 and beyond. And this is something that it is now an enterprise plan and enterprise strategy, and we'll continue to pursue this to get the balance sheet debt much lower. With this, I will end here and open the floor to questions.
Thank you very much. We will now begin the question and answer session. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question at the audio bridge may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Participants connected at the audio bridge, if you wish to ask a question, please press star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Anand Dixit from Edelweiss. Please go ahead.
Yeah, hi. Thanks for taking my question. I have a couple of questions. Congratulations for a good set of numbers at the outset. I have 2 questions. The first one is on your capex plan. While you have illustrated the plan for the pellet plant and CRM, so if you can give us the total capex that would be incurred in these 2, and what is the minimum debt to EBITDA or debt to equity you are looking before going ahead with KPO2? That is the first question.
Yeah, so I think when we slowed down the pellet plant and cold rolling mill, I think the pellet plant is about 40% complete. The cold rolling mill is much less. And we are factoring in the spend in the financial year 22. And we will also spend, it's not that it is sequential that Kalinganagar will not start before the debt numbers are there. But there are some enabling works that is required, and we will do that in financial year 22. But that will not be very significant in FY22, but it will possibly be much more in 23 and 24. So that's broadly the direction at which we will go for KPO. So I think there's been a view that unless we come to a debt number, we will not start it. I think given the accelerated deleveraging that we have come to, and we will continue to do so in the future, I think one benchmark is that we will continue to deleverage by about $1 billion, which is about 7,500 crores. And if we can achieve what we have stated to achieve by 31st of March, which we are confident of, then subsequent we will be looking at least the KPO completion to be accelerated, but we will take it in a calibrated manner. Within KPO, the pellet plant and CRM are margin expansionary and therefore gets a higher priority, and thereafter we will look at the upstream. As far as the leverage ratios are concerned, I think we have said in the past that we were looking at debt equity of 1:1, and as far as net debt to EBITDA is concerned, we're always looking, given the fact that we have a strong pipeline of growth, we were looking more around 2.75 as our comfort zone, and that's something that we will certainly push for. But that doesn't preclude us from doing more deleveraging if the market holds and our operating cash flow continues to be strong, which is what we are looking at. And therefore, that 1 billion fits into that very well, that anything over 1 billion, we will look at optimizing between the capital structure and the CapEx.
Any ballpark number you would like to give for CapEx for FY22?
Not yet, because that's what we are working on as currently. I think in the next few weeks or by the end of March, we will be in a better position when our annual plan gets finalized. So just hold for some time, and it will certainly be much higher than what we have spent in India this year. There is some amount of catch-up that needs to be done, and some of the critical capex, and also the pellet plant and CRM.
Okay. The second question is on the slide number 11 of the revised deck, in which you have this consolidated cash flow movement bridge. So there is a working capital movement of 7,218 crores, which appears to be very significant. If you could throw some light on that, where did this release come from?
So let me first step back and mention that you would have seen that in the first 2 quarters, we have significantly taken out our working capital. If you look at the September quarter as well as in the June quarter. So that was fundamentally taking out on inventories and debtors and tightening on creditors and so on. As far as this is concerned, there has been an improvement in the working capital, but the substantial part is because we've also tied up export advance in ahead of our commitments for the next few years, and that's the liquidity that you see as far as that block of numbers that you see. That's almost plus 6,000 crores.
Okay, understood. Thanks, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, sir. Thank you for the opportunity. My first question is on Europe. So I remember a couple of quarters back, we were in discussion with the UK government for a long-term permanent resolution for the Port Talbot asset. Any update on that? Anything we have progressed since then?
So basically, the conversations are going on with the government. I don't think we've come to a conclusion yet. There are different options being explored. The government has also appointed some technical consultants to engage with us to look at different possibilities. So it's at that stage. The conversation is going on, and we are exploring what could be the possibilities.
As a follow-up to that, so in Europe, is it safe to say that now for strategic partnership, we have to look at partners outside of Europe per se, maybe a Chinese partner or something, because otherwise CCI or some other issue may actually hinder a strategic partnership with any European player?
No, I think just now we are focused on transformation, which we were focused on even earlier. I think in the SSAB case, SSAB had reached out to us, so it was not that we went around looking for potential partners. And so our focus continues to be a bit more internal to drive transformation, to drive cash self-sufficiency, have discussions with the government to see what is it that they can do to support. And if anybody expresses interest, we'll deal with it as appropriate.
Sure, that's helpful. A couple of housekeeping questions. So the reversal of provisions or the provisions that we have seen in this quarter in Europe, that is for about 94 million pounds of wage reversal and the carbon credit of 110 million pounds. This is entirely of prior period, or there is some amount in this period as well? So I'm just trying to understand what is the like-for-like EBITDA in that business, say if I compare with say 1Q or 2Q.
So as far as the carbon, the now provision is concerned, that is actually the reversal from the September quarter. But as far as the carbon is concerned, that's provision for purchase of carbon, which has not yet happened, but will happen in the fourth quarter.
Okay, that's helpful. And lastly,
yes, yeah. Go ahead, Indrajit.
Okay. Lastly, on the capital advance, on the advance on exports of 6,000 crore, is it interest bearing or it's just operating kind of arrangement?
No, it is interest bearing because it is. But the question is, the quantum it reflects very small amount of underlying.
I'm sorry to interrupt you, sir. Your voice is breaking up.
But it is interest bearing. Yeah.
Mr. Chatterjee, the answer was not clear actually. I think there was some disturbance in the line.
I'm sorry to interrupt you. Members of the management, your audio is unclear at the moment. May I request you to please check? Ladies and gentlemen, we would request you to please stay connected while we check the line for the management. Ladies and gentlemen, thank you for patiently waiting. We have the line.
What I said is that the advance relates to
So we lost the audio again now.
Yeah.
Members of the management,
Can you hear us?
Now we can hear you, sir, at the moment. I don't think we can hear you right now, sir.
Ladies
and gentlemen, request you to please stay connected.
You can hear us?
Ladies and gentlemen, thank you for patiently waiting. We have the line for the management reconnected. Over to you, sir. We have Mr. Indrajit Agarwal in the question queue.
Yeah, Indrajit, are you there?
Yes, I am.
Yeah, so what I was saying is that, yes, this advance is interest-bearing at a very attractive cost because it's part of the trade finance, and it represents a very small part of our overall export portfolio. These are two things that I was mentioning.
Sure. Thanks a lot for your answers. All the best.
Thank you.
Thank you. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, thanks for the chance. So first question is with respect to the Europe demerger which we are working on. Just want to understand better what are the benefits of this demerger we are looking at. Is it something that the cash fungibility will stop from New Zealand assets to Europe, to UK, sorry? And in case of a demerger and given the losses of UK, how will the cash burn be funded post demergers?
Yeah. So I think the whole focus on demerger in some sense of the term was to see that the strategies for each of these companies is slightly different. While we started doing this, when the SSAB transaction was being discussed, we saw the value in keeping it that way because we will have a sharper focus at each of the entities at a local level. We will also be able to drive performance better at a local level. That is one. Secondly, it allows us more strategic options going forward, particularly since we are talking to the governments in both places, also to help us with the transition into a lower carbon footprint. So in all these conversations where the government is also involved, it is easier to have a local entity which is separated out from a Tata Steel Europe kind of entity. So this was the second advantage. And the third thing is, as we were going through this process, we also saw that we can look at costs very differently and run these businesses more efficiently by taking out some of the costs while at the same time not losing the benefit of being part of a larger family because the scale benefits come from being plugged into the Tata Steel Group procurement system and things like that. So we saw the gains much more than the inconveniences that it may bring and hence decided to go ahead with it. As far as the cash is concerned, basically, as we've said, even at Tata Steel Europe level and also at a local level, what we are working towards is to be both cash neutral and cash positive.
Understand. The second question is with respect to the merger of the two entities. One is Bhushan and the other one is Tata Steel Long and Metallics. The press release says that both these mergers are underway. So is it possible to share any update as to, especially with respect to Bhushan and any movement in the last many quarters and both the mergers? Any updates possible to share, sir?
Yes. So I think, Sumangal, the NCLT has given direction to all the EGM. We are getting the formal orders, and after which we will put it up to the boards and ensure that the AGM is held as directed by the NCLT. So once that happens, then a big part of the process would get completed, after which we go back to the NCLT with the outcome of the EGM and go through the rest of the process. So that's the Bhushan process, which will happen faster than the other two, which is TSLP and TML, where we are approaching we've done the scheme and approached for various approvals. It has gone through the various regulatory approvals, which is what we are filing. But the Bhushan one is certainly has picked up momentum, and we are focusing on it to get it completed.
Understood. And one just last question, if I may. On the KPO timelines, looks like if we start next year...
Sorry to interrupt you, Mr. Nevatia. Your voice is not very clear, sir. Can you please check?
Yeah, sorry. Yeah, hello? Am I audible?
This is better. Thank you.
Yes.
Yeah. So on the KPO timelines, wanted to understand how long will we take to complete it, even if we start the capex next year, And also, since now our pending equity would get completed given the partly paid up calls, are we open to raise further equity given the KPO project is a very high IRR and a attractive value accretive project for us?
So I think the KPO project would take the pellet plant and cold rolling mill, as I mentioned, and Naren also mentioned a little while back. We're looking at about a 12-month period by which we should be able to complete. 12 to 13 months, yeah, that kind of stuff. It's a way in which the pellet plant will possibly come faster. The PLTCM will, the cold rolling mill also has 2 stages, so the PLTCM will come first and the rest will come a little later. So by the time the entire CRM is completed, it will be between 12 to 18 months in phases. The pellet plant is a more one-shot commissioning that will happen. As far as the equity bit, we are not looking at equity. We're just looking at closing the partly paid now in the next couple of weeks as the process goes forward. So by end of March, we should be looking at that. And then I think based on our internal generations as we see it currently, we are focused, as I said, that's why I think I was more nuanced that when I said anything above $1 billion, we will optimize between capital structure and capex. Effectively saying that if we have the opportunity to accelerate KPO, I'm sure as the company and the board will look at doing that. And that would effectively take about roughly about 36 months to complete.
Got it. Thank you and all the best.
Thank you.
The next question is from the line of Sanjay Parekh from Nippon India AMC. Please go ahead.
Yeah, thank you. And commendable results and really very encouraging deleveraging and very clear roadmap for deleveraging. All my questions answered. Only one question I had is, if we were to come to support the European subsidiaries, Europe and UK, what would be our stand? Or do you think that they would be, they can manage on their own? What would be your view? Because historically, that's been one concern. And the second question is...
historically...
Yeah, please.
Go ahead.
Yeah, please go ahead.
No, I said historically, Netherlands has always been cash neutral, cash positive. So that's certainly doable. I think we're working with the team in Netherlands to ensure that happens. I think that has happened in the past, and hence no reason why it can't happen in the future. UK has been the challenge, but in UK also a lot of heavy lifting has been done over the last many years. We've shrunk the footprint, taken out a lot of costs, and we will continue to take out costs as we run with the transformation project in the UK. And we are also waiting to see what are the actions that are going to be taken in UK to keep the UK economy going post-Brexit. And that could also help us because we are a very important part of the UK steel manufacturing value chain. So as the manufacturing activity in UK hopefully picks up, we will be in a better position to cater to that. So in UK is where there's a greater challenge in becoming cash neutral or cash positive, but we've over the years shrunk the size of the problem very, very significantly. So I think we are, getting towards where we want to be, and some more work is required.
Just to add to what mentioned, Netherlands actually has been free cash flow positive for many years, except for the last couple of years, and therefore our focus is to bring it back in that, and some way the demerger actually helps in sharpening the cost focus on the local sites, both in the UK and we are effectively going to become very lean in as far as UK is concerned. So both these actions will help us in ensuring that the cash preservation in both these sites are optimized, and we can then look at cash neutrality for both these sites, especially in Netherlands, where it will be focused on being cash positive rather than just being neutral.
Thank you. Another question I had is on the demand. Because the prices have moved up quite sharply because of also input prices going up in our case. So Do you think there is an impact on demand in certain segments that you're seeing where it's not viable for the end use, both in flat and long?
So I think, are you talking in India or generally, globally?
No, sir, India.
Yeah. So, steel prices go up and down, and what we've seen now is not, at least in dollar terms, is nowhere near the highest prices we've seen in the past. And if you look at prices in Europe and in US, in dollar terms, it's even higher than what it is in India. So I think across the world, consumers deal with this fluctuation. It is one of the challenges of this industry, both to be in the industry and to be a customer of this industry, because it's driven by global factors. Having said that, I think for most customers, steel is maybe 5%, 10% of the total cost. So unless you're a re-roller or somebody like that, if you're a final consumer of steel, if you're an auto company, if you're a construction company, etc., the percentage of steel as a percentage of the total cost is, not very significant. So I wouldn't think a project should become unviable just because steel prices going up, for a few months. I mean, it's not even something which stays at very high levels for very long. It fluctuates within a band. So that's the way I look at it. But overall steel demand, I do believe, with the focus on infrastructure and fixed investment-led growth, the steel intensity of India's growth should improve, which is good for us. Because traditionally in developing countries, the steel consumption has to grow at greater than GDP, whereas over the last 10 years, we've grown at less than GDP because it's been more consumption-led growth and not so much infrastructure or investment-led growth. So I hope that will change over the next 10 years and the demand growth will be better than the GDP growth rate.
Thank you very much. Thank you.
Thank you. The next question is from the line of Pinakin from JP Morgan. Please go ahead.
Yeah, thank you very much, sir. So my first question is on the balance sheet and net debt. So just to clarify, the 86,000 crores net debt number that we have as of December becomes the starting point, and going forward over the next 2 to 3 quarters, we should not have a material working capital reversal, because the press release mentions a gross debt reduction but does not talk about net debt reduction in 4Q.
Yes. So I think working capital, reversal beyond where we are is going to be difficult. In fact, with the increase in prices, we've been able to make it very tight. And you see that the coal prices have also inched up, and steel prices and finished goods inventory effect is also there. So the focus obviously is on the gross debt reduction, and our need to keep such high level of cash flows is not there, given the strong generation. So that's why we're focusing on gross debt, and we're going to bring that down substantially, and obviously focus on keeping only the optimum liquidity required. So there will be a derived number for the net debt.
Sure.
Was that your question?
Yes. And my second question is, sir, that over the next 2 years, is it fair to assume that from the operating cash flows, the first $1 billion would go towards further net debt reduction and then capex will pick up, or from FY22, both capex and net debt reduction would be, optimized in terms of what is the priority?
So our first focus on deleveraging is rightly the 1 billion net debt reduction. I think if you are running an ongoing company, you can't say that we will first reduce and then do it. But so long we have a fair line of sight, we are focused on ensuring that in priority of capital deployment, the net debt comes first. Then comes the mandatory capex and the ongoing approved capex. And then we need to, if the momentum of the cash flows continues to be as strong as we are seeing, then we will have to balance between delta capital structure and only on the ongoing projects, which is the Kalinganagar, as all of you have written about, is to accelerate and ensure that gets completed about. So I think the clear deployment is first from cash flows goes the net debt reduction, then goes to the critical and continue the ongoing capex schemes and the capex plans, and then comes the discretion. So if after doing the first two you still have enough of capital, I'm sure we will do a balance between accelerating some more of the net debt and also looking at critical growth capex.
Sure, sir. And just to lastly to clarify, I mean, we have seen a lot of steel price movements between December and January in the spot market. There was news about steel companies going to the auto companies and getting an interim price hike. Can we get a sense of how realizations or NSRs of the company should move between December and March?
So I think on an overall basis, for multiple reasons, not just the specific product level prices, but also because of the improving mix as well as the better realizations from export orders which were booked towards the end of last quarter, which are at high prices. We expect the realizations this quarter to be about 6,000 to 7,000 rupees higher than last quarter.
Understood. Thank you very much, sir.
Thank you. The next question is from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Yeah, hi. Thank you for taking my question, sir. So firstly, just to be a little more clear on the export advances, these advances will stay after the commitment to deliver material is over in the next 2-3 months. How should one think about these advances? Is it something which is going to stay for a longer period?
Yes, this will stay. So there is a gradual phase up of this advances backed by a certain volume, which is actually about 500,000 ton volume every year for the next couple of years. So this, as we go forward, this will be able to be paid out as and when we dispatch for exports. So this is part of our overall export. It's not an increased volume of export. This is well within our long-term average of about 10-15% export volume. And the way the formulation works is also that this is adjusted to the prices. So if the prices go up beyond our base prices, the volumes go down because you realize the same on lower volumes, and you have then the opportunity to put that volume into the domestic market. So, and the overall basket for this is, as I said, is well within the export basket. We were anyway doing it currently.
Got it, sir. So secondly, data point on Europe. On a free cash flow basis, what would be that number for Europe in 3Q and for 9 months fiscal 21?
So, using 3Q or 4Q?
Sir, 3Q, what was the free cash flow number for Europe in 3Q and for the 9 months?
So, at the free cash flow level, after capex, dividend, interest, working capital was roughly about minus 900 crores.
So this is for 3Q, you said?
Yes, correct.
And for 9 months?
And for the 9 months was a positive 700 crores.
Got it. Sir, lastly, on the transformation initiatives, you have talked about it in the past. So where are we right now? Is there more to come with respect to cost savings in the near term, next 3 months to 6 months, or these are something which will be realized over a longer period of time and large part of the transformational initiatives have already been realized in the P&L? Thank you.
Yeah, so this is ongoing. There are multiple initiatives under transformation. There are multiple streams which are being worked, and some of the benefit has already come in. Obviously, the pandemic diluted some of those benefits, but even if you look at it on an underlying basis from Q1 to Q3, there has been a significant improvement, to the extent of, I would say, about 200 million euros between Q1 and Q3. From an underlying basis, there's been an improvement. But this is an ongoing activity. It will take at least another year for a lot more of these benefits to flow in. So, this is linked to operation improvement, procurement improvement, market mix and product mix improvements, as well as people-related actions, etc. So there are multiple work streams which are working on this.
Thank you, sir.
Thanks.
Thank you. The next question is from the line of Rakesh Jhunjhunwala from Rare Enterprises. Please go ahead.
Sir, congratulations on a really fine performance. So what I wanted to ask is,
Thank you.
what is the one-offs in Europe this year, this quarter? The total quantum.
About 700 crores of the one-offs, which is essentially the reversal of the employment grant scheme in Netherlands, as I mentioned in the early part of my narrative, and that's been recognized because there was a certain conditions to kind of take on board, which we didn't qualify for, and therefore it got reversed.
Without the one-offs, you would have broken even in Europe.
Without the one-off, you would have been in positive zone.
So another thing is, you say your net debt is 86,000 at the end of the third quarter, and you hope to be generate another 12,000. So this 12,000 is without the rights money or with the rights money?
Without the rights money.
So that means effectively your debt will be between 70 and 72,000 crores net at the end of the third quarter, at the end of the fourth quarter.
No. So the end of the fourth quarter, we would be more around 80 plus.
12,000 crore is gross debt reduction.
Yeah, it's a gross debt reduction, not the net debt reduction.
And right. And so in prices, you said you had about 6,000 crores higher than last quarter. So why you keeping 20,000 crores?
No, we will be paying off. So that's why I said that we will be, in fact, somebody, I think Pinakin asked that question. So I said that's why we are focusing on gross debt reduction, because our gross debt will come down fairly steeply by the end of this quarter.
And sir, I understand that you have to get some tax benefits with the merger of Tata Steel, Tata Bhushan. Am I right? That you will be able to set off some carry forward losses. Hello?
Yeah, Bhushan. Yes, can you hear me?
Yes, but
can you hear me?
What is the expected date of the merger?
So the NCLT has given the order to hold it in March. So we are expecting the formal order, after which we will hold it, and then we will put it back to NCLT with the outcomes and all the processes that happen with the ROC and the other regulators.
One is
so will certainly be.
So because the effective date can be other than the day of the merger, it can be prior to the day of merger also.
So the effective date is April 1st, 2019.
But sir, then what is the quantum of the tax benefits?
So the Bhushan has north of 15,000 crores of tax losses. So we will. It's a bit complicated. Maybe I'll talk to you offline and explain, because it is a complicated process, but it effectively that will come into Tata Steel, and we have to do the adjustments of the tax paid from 1st April 2019 and so on.
So that means, sir, why are you making this tax provision? Because when the merger takes place, you write back all these provisions, sir. At the benefit will amount of the tax loss is 15,000 crores, the benefit will be about 4,000 crores. Are you paying the tax?
Yeah, broadly. No, we are. So that's why I said that we are doing in our cash flows this year. We are factoring in the merger and hence adjusting to that extent. And we have got time till we file in all the returns and so on. So we are doing that cash flow work, keeping a very close eye on what effectively will be the tax outgo. And you can see that in our cash flow.
You will write back this tax provision and your equity will go up.
Yeah, there is a reversal that will happen.
And therefore, network will go up by 3,500 4,000 crores. And the tax benefits are already taken. Is that right, sir?
Yes, you are right.
So that means next year you will reverse it down by 3,500. Once the merger is approved, if and when, you take a tax write back of 3,500 to 4,000 crores. That will happen next year.
So we have to do the full Rakeshji, we have to do the full analysis because as the effective date is 1st April 2019, 1st April is 2019, we have to factor in what was paid in that year, adjust it. Then we have also opted for the lower rate of tax when the option was given by the government. So it's a fairly complicated stuff, and but fundamentally the TS Bhushan does have about, as I said, about 15,000 crores of tax loss.
Thank you, sir.
Thank you.
Thank you. I hand over the floor to Ms. Samita Shah to take the next questions received on the webcast.
Yeah, we have a question from retail investors about the NRs we had for the third quarter. And also, I think there are concerns that there are a lot of noises in the media as well as the government about the government imposing some kind of price restriction. So, what is our view on this?
Yeah, NRs for the third quarter, what is the increase?
NRs, what are the net realizations for the third quarter? Third quarter. Yeah.
Q4 over Q3.
Yeah.
Yeah. So I think on Q4 over Q3, as I said earlier, we expect the realizations to be about 6,000 to 7,000 rupees per ton higher. It's not just because of price increases. Price increase is part of it. Part of it is because we will realize better. We'll have better realizations from our exports because the export orders are at pretty good prices, and also because of mix impact because we continue to have a richer mix. In terms of government, we've not heard anything directly. Whatever we are hearing is, I think, speculation in the media. We've not heard anything directly. And I think steel is a global industry. 400 million tons of steel moves across border. Typically, 5 to 10 million tons of steel gets imported into India every year. So the steel prices is, particularly in flat products, very reflective of international prices.
Thank you. The next question is from the line of Bhavin Cheddar from Enam Holdings. Please go ahead.
Yeah, good afternoon, sir. Overall, congrats on the deleveraging process and operational efficiency all across. So, my question is on Europe going into quarter four and ahead, and I believe the adjustments related to the Netherlands entity wage support has also been taken.
Sorry to interrupt you, Mr. Cheddar. There's some disturbance from your line. Your audio is not very clear.
Is it clear now?
This
Hello?
is better. Thank you.
Yeah, we can hear you.
Yeah. So the Europe operations would have a normalized EBITDA from quarter four. I'm asking this because the spreads of Europe are at all-time high of $450, $500, and historically you have guided us the conversion cost there at roughly around $200 to $230. So, are we looking at record numbers in quarter four in the Europe, and are there any adjustments still pending for the European entity in Q4?
So Bhavin, yes, the spreads have certainly improved and increased, and the felt spread, which is the spread relating to Tata Steel Europe, will be higher in this quarter compared to the previous two quarters. And therefore, we do expect that Europe should, on an underlying basis, report much better results than what we have seen in the first three quarters. I can't say that that will be best ever because the conversion price cost that you talked about is not, it looks understated.
See, the second thing is what you are mentioning are the spot spreads, but in Europe, a lot of our contracts are annual, 6 monthly, quarterly, and they're long-term contracts. So they are not necessarily fully reflective of spot prices. So there will be a difference between spot spreads and what Kaushik referred to as the felt spreads. Yeah.
Sure. And have the adjustments of this wage support, which was there during the pandemic and all that happen, or we still have something of a reversal which is yet to happen both at UK and Netherlands?
The wage support is over. There's no further wage support because that's got reversed now, whatever was provided earlier.
Sure. And the last question, Kaushik, you guided for net debt numbers of 80,000 crores, though the gross debt reduction is higher and we will be receiving over 3,000 crores in rights also. So are you expecting some working capital reversal in quarter four? Because I believe the export advances, what you have taken over 6,000 crores would be for a longer period of time. So which other working capital heads are you expecting there would be a reversal and hence the net debt reduction which will be much lower than the gross debt number?
No. So if I look at it, I think Rakeshji asked about the a number on the cash flows, why you were sitting on very high cash flows, which was a very legitimate point. I think what I mentioned is that we are focusing on reducing the gross debt and we don't need to keep so much of liquidity. And in view of that, so he asked whether it was 70,000 crores. I said the net debt will be around that number, maybe slightly higher than that, 80 plus. And we will be using, it's not limited to 12,000. If you really look at my commentary there, I have said more than 12,000. Fundamentally because we've been already in the month of January, we have taken out about 6,200 crores. In February, we are well on our way to take out another 7,000 crores. So I just said that this is more than that. In fairness, whatever line of sight I had, I have put it in the commentary that it will be more than 12,000 crores.
And I think the difference between gross and net will be the reduction in cash.
Yes, yeah, correct.
No, so just a clarification. So we are expecting a net debt number reduction of similar levels. That's what my question was. Though
no. So the net debt, as on we started the year with 1,04,000 crores of net debt. We have come down to 86,170 crores as on December. The net reduction will be lower than the gross debt deduction, is what I'm just saying. And it is logical because that's the way in which you will use the excess cash or the excess liquidity and the current cash generation to reduce the gross debt number more. So the gross debt reduction will be far more steeper than the net debt reduction.
Thank you. I would request Mr. Chedda to rejoin the queue for follow-up questions. The next question is from the line of Amit Murarka from Motilal Oswal. Please go ahead.
Hi, good afternoon. So first question was on the carbon credits. So I understand that because it's a new calendar year, so you would have received fresh credits in Europe now. So just to understand how it works for you from a provisioning point of view. So now that it is there with you, the new credits, will the provisioning be much lower now? Because I believe you sold CY20 credits somewhere around 2Q CY20, which caused maybe higher provisioning. Is that understanding correct?
Yes. So I'll tell you that every year you get allocation based on production numbers. If the production numbers are higher, then you need to do the provisioning. If the production numbers are the same on the baseline, you don't need to. The last year, when the pandemic and the lockdown happened in Europe in the first quarter, where the demand slump was high, we had monetized part of the carbon credit, which was seemingly at that time excess to the production numbers, and that's why you see these provisionings on the repurchase. But otherwise, you would normally be balanced, and these carbon credits will not have too much impact unless we are increasing production numbers, and for which we have to buy additional entitlements. So that's in a normal course, you don't see that as sticking out in these numbers as you see currently.
Sure, but now that you would have received fresh credits for CY21, so in 4Q, then we should not expect much provisioning, right?
It will be to the extent of the so those credits which were sold in the first quarter will have to be repurchased and repurchased at the current price. So there will be to that extent a differential provision, but that's not. It's like tapering on. Whatever is the large part of the provision has been done. There will be some provisioning which will be done in Q4, but after that, when the new reallocation happens this quarter, which is a calendar year, and you're right on that, then at the same base level of production, you don't need to do that. If you are increasing production in our plan for the next 12 months, then you have to get delta purchase, which is not envisaged significantly at this point of time.
Okay, understood. And the second question on the export advances. So, like the 6,000 crore number broadly translates to at current prices about 1.2, 1.3 million tons, which would be close to your annual exports. So, is it fair to assume that, let's say, FY22 exports that you make will largely be settled against this, and this will get over by end of FY22 then?
No, I had answered this question a little while back that it's a multi-year basis. So the number involved is about 400,000 to 500,000. So therefore, if it's per annum, so therefore we will settle it in the next few years. And as we settle, only thing is if the prices remain high, we will settling it with lower volume and lower than the 400, 500 numbers that we are talking about. And if the prices remain at the base level, which was when contracted, which is lower than what the current prices are, then we will run it for a couple of years from now. We have started the numbers from exports on this account in quarter 4, and will continue for the next few years.
Sure. But is this a change in policy now going ahead? Like, will you look to book such export advances going ahead, or was it a one-off measure?
At this point of time, it's more like a one-off. It was also contingent on what the market conditions were at the time when the pandemic opened up. The need for liquidity and the need for ensuring that we lock in some of the exports and look at also new markets in exports with the help of this plan. I think we will have to review going forward, but at this point we don't have any plans. In case we find the need, we will review it, but at this point we have only this one. And this is the first time, and I don't know whether it will be repeated often, but certainly to be seen as it pans out.
Thank you. I would request Mr. Murarka to rejoin the queue. The next question is from the line of Amit Gupta from Bain Capital. Please go ahead.
Thank you. Thank you for taking my question. So I have a question on the Tata Steel partly paid stock. Now you recall the stock yesterday in the announcement, and the record date is 19th Feb. Now 19th Feb is just a few days ahead, and this has led to the panic in the stock market. The stock is down 15% down today on a lower circuit. There are no buyers in the stock and only sellers. So can you look at extending the record date by a couple of weeks so that shareholders get a chance to exit the stock or the price gets stabilized? Thank you.
We take your feedback. We'll look at it, but it is also important it's gone on for too long to keep it open. I think there was earlier a sensitivity of people saying the stock's much lower than the call, and therefore our board had taken extraordinary decision to keep it on hold. Now when the stock's much higher and even people who have participated in the original partly paid had the opportunities. So I think we'll certainly look at it, but you should also factor in the point from a company's point that we've been holding on to it since February 2018. And therefore, to be fair to everybody, that when the price of the stock has performed and the base level price of 615, which was set for the partly paid for the rights issue, is now for that part is well and much beyond that level. It is important for us to also close the fundraising efficiently and quickly.
Thank you, sir. My only concern was if a couple of weeks it can be extended the record date. Thank you. Thank you very much.
Okay. Thank you.
Thank you. The next question is from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yeah, thanks for taking my question. I have 3 questions. First of all, what is the outstanding export advances as of now? Second is, if you can highlight the trading loss that you have incurred on carbon credits this year in Europe as of 9 months. Number three, the question is on Tata Steel long products. So, we are seeing a company getting created with almost a 4,000 crore kind of a network. So, what are the, and probably hardly any borrowing to be left over the next couple of years. So, what can be the expansion plans? What can be the, leveraging plan within this balance sheet to sort of expand the current 1.5 million ton capacity? If you can sort of throw some guidance or outlook on that. Thanks.
So, your point on TSLP was what? Can you just repeat it shortly? That what's the strategy for TSLP? Is that your question?
Yeah, in terms of how to utilize this balance sheet, which has almost 4,000 crores of net worth, and what are the kind of expansion plans that one can look at currently, which is standing at 1.5 million tons. Because earlier you have mentioned that by merging all these three companies together, the idea is to create a much bigger company and have a better balance sheet to create that that kind of scale to expand further. So any sort of thoughts, guidance, outlook that you have had formed up?
So I'll make a few comments and then I'll give it to Naren. So first is, while it has a 4,000 crore net worth, but it also had 2,000 crores of debt. And we've been very focused on, again, deleveraging that balance sheet to ensure that from a financial risk profile perspective, it becomes a lot more solid and robust. And I'm happy to say that for all the efforts that our colleagues have done in TSLP in taking out costs, when the right time in the market came in, they've been also being significantly deleveraging Tata Steel long products. So that's one part. Second is that hub is created as a long products hub for the growth in the future, and we certainly see opportunities, both organic and inorganic. One part of strengthening that company with a multi-product portfolio was the proposal to merge Tata Metallics into, as you know, Tata Metallics is a debt-free company or almost debt-free company, and that merges brings in the EBITDA and makes it a lot more stronger. So the entire portfolio, including downstream, as we have also merging ISWP, the wire business, and gradually we are going to build that as the long products. We see opportunities in the long product space, again, organically and inorganically, and we will ready it for future growth. Naren, you want to add?
No, it becomes a vehicle for long products growth. I think that's fundamentally the objective of creating that cluster and that company. And it's already now one of the biggest players in the DRI business and will become a big player in the foundry grade pig iron business once we merge it with metallics.
And see, currently it's 1.5 million ton producer. So, and almost 75% of the shares still rise with the secondary producers. So, can we sort of think of it becoming a 5-6 million ton player eventually over the course of next 3-4 years or 5 years maybe? Is that the sort of thought process that we are going towards with this company, or?
Yeah. So I'll tell you, we have also talked about the recycling business that we set up. The first steel recycling plant has been set up by Tata Steel in Rohtak, and that is operating. It's a 500,000 ton recycling facility. We are also exploring a different avenue for growth for long products, which could be recycling led, which could be electric arc furnace led, and which will help us grow our footprint in the north, west, and south over a period of time with multiple units, distributed production, collecting scrap, melting it, rolling it, fabricating it, and selling it, just like we do in Singapore, Nat Steel, etc. So that is a model that we are exploring for viability, the economics of it, and the Tata Steel Long Products company will be the vehicle for all those, exploring all those options. Because the parent Tata Steel will be more flat product focused on 3 major sites after the Bhushan merger. Angul will be one of the 3 sites. We have Kalinganagar and we have Jamshedpur. So it will be a more flat products, integrated steel plant kind of play, whereas Tata Steel Long Products will be more long products, distributed production, specialty long products also, and a little bit of a different operating model and different kind of structure.
Okay, great. It may not be as capital intensive. Yeah.
Absolutely. In fact, Actually, the growth model for long products could be capital light because we have many partners who are willing to set up these facilities for us, like the scrap recycling facility was set up by one of our partners, we run it. Similarly, we believe that in that model you can set up smaller facilities where we underwrite the capacity and add value through the quality control and through the distribution network and the customer equity that we have.
Great. Yeah, and then those two questions in the outstanding export advances as of 9 months 21 and the trading loss on carbon credits in Europe for 9 months 21.
So Abhijit, as far as the outstanding export advances is concerned, as I said, that we just started, and the entire amount, some part of it will be satisfied in the fourth quarter, but over every year we will be looking at about 400,000 tons of volume at a certain base price which we have determined as a formula. With the price increasing, the volume goes down. That's what I mentioned a little while back. So at this point of time, the entire amount is almost, it just started. So it's not that it's just come, it was there in the books and we've not talked about it. So that's the first part. And the second part is the one-off provisioning on CO2 is about 54 million pounds in 9 months' time.
Okay. Thanks. That's all from me.
Thank you.
Thank you. The next question is from the line of Vineet Malu from Birla Sun Life Insurance. Please go ahead.
My question is answered. Thank you so much.
Thank you. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity. First, I'd like to congratulate the team for A- rating on CDP and putting on sustainability targets for both India as well as Europe. Thanks for that. So I have 4 questions. First is on export advances. Sir, you indicated a number of 6,000 crores. I just wanted to understand what is the full blown out number that we can look at over here. If I remember it right, the instrument what we had availed was for $1.2 billion. Is that number correct?
Yeah, not 1.2. It is 1.
It is $1 billion. Okay, that helps. That is one. My second question is on iron ore security for India operations. What is the percentage of iron ore which is captive right now, and any specific view that we have on these expiries by 2025 or 2030? And if it is by 2025, then what is the mitigation strategy, or how are we looking at the scenario? That's the second question, please.
Yeah. So on iron ore, we are self-sufficient. Obviously, we are expanding our iron ore mining activity to support the requirements of the steel business. So that will continue. We will continue to expand, and the objective is not to have to buy iron ore in the market, though for a few months here and there, sometimes we do have to when the iron ore expansion has not kept pace with the requirements of the steel plant. So that is one part. The second part is, as of now, our leases are valid till 2030. We have no reason to believe otherwise. And the recent MMDR Act has very clearly, left it as it is. So I think we are comfortable till 2030. We are waiting to see whether any iron ore sale will be allowed. I think we are waiting to see the details on that. And then we'll take a call if we need to expand our iron ore mining beyond what is required for the captive use.
That's helpful. My third question was on sustainability and Europe. In the presentation, we have indicated 300 million euros towards Tata Steel Netherlands. Now, if one looks at the carbon intensity numbers for UK, it is significantly higher than Netherlands. So just wanted to understand what is our capex commitment for both the regions. We understand UK is not probably as good as Netherlands. But when we look at incremental capex, current carbon prices, and forgive me for my ignorance, but I think under EU ETS phase 4 at some point in time, they are looking at benchmarking on assets. And that is something which can actually create a lot of trouble for the UK operations. Now, if that's the context in which we are looking at capital allocation and the risk on carbon, how is the management approaching the scenario, please? Thank you.
Yeah. So, if you look at the Netherlands unit, for a blast furnace operation, it generates 1.8 tons of carbon per ton of steel, which is, I would say, in the top 5 in the world from a blast furnace operations point of view, and probably certainly the most efficient, if not probably the most efficient in Europe. In Port Talbot, it is 2 tons of carbon per ton of steel, which is by global standards very good. Just to give you a sense, in India, Tata Steel in Jamshedpur is a benchmark which is at 2.27. Okay, so our European plants are way ahead of most plants across the world. At 1.8 and 2, they are pretty much in the top quartile, if not top decile. So that is one point. The second point is the 300 million, etc., is more to deal with. It's a multi-year kind of plan to deal with some of the issues which have been raised by the local communities, and this is more to deal with local environmental issues. As far as transitioning into a low-carbon future is concerned, Europe is drawing up a lot of plans for that, also creating funds for that, because this transition is not going to be cheap for anyone, and Tata Steel is probably better positioned because its carbon footprint is lower than for most of the blast furnace operations there. But nevertheless, the cost of transitioning into a lower carbon environment is going to be expensive, and so the conversation which all steel companies are having with the local governments is what is the government support that can be available, because the industry by itself cannot bear the cost of transition. It has to be shared by the government, and also customers should be willing to pay a higher price than for greener steel. Government is certainly looking at it seriously. Multiple governments in Europe have announced that they are keeping aside funds for it. Even in Netherlands, the government has said that they want to decarbonize without deindustrializing. So there is a lot of support coming from government. It is yet to be defined more specifically. The governments are also redefining the carbon commitments for 2030. I think COP26 in Glasgow will also lead to some announcements and a transition plan and funding for the transition plan. And I think that is the other things being discussed in Europe is a border adjustment tax, because if European steel companies have to incur the cost of transitioning into a more carbon efficient footprint, then they should not be disadvantaged by steel coming in from other countries who are not incurring those costs. So that's also a discussion going on with the European governments, and I think it will be a more holistic approach from the government so that industry is not disadvantaged unfairly, while at the same time the objective of transitioning into a greener environment is fulfilled. So policy is evolving, advocacy is going on, and the technologies are, if you see in Europe, they've also kept aside a lot of money for building a hydrogen ecosystem, So all this is going to help the transition, and I think generally we've seen Europe has led the way on the subject, and we are part of that process.
Thank you. We'll take the next question, which is from the line of Anupam Gupta from IIFL Capital. Please go ahead.
Yeah, thanks for taking my question, sir. So just continuing on Europe, based on whatever transformation efforts which you have taken so far, what are the sort of cost levels which you have reached in terms of per ton conversion cost? You mentioned that it's higher than 230, but what's the sort of level which you have reached, and what's the sort of target over the next couple of years which you are aiming to reach in terms of conversion cost specifically?
So I think I'll put it this way. The transformation program was to give us about 700 million euros in 5 different heads over 3-4 years we were supposed to run with that program. And I would say we are pretty much halfway through that program. In terms of conversion cost, the conversion cost is a moving number depending on even the price of raw material. For instance, when you have a high price raw material, even the cost of yield is higher, which gets factored into the conversion cost. Right, so the conversion cost is not a fixed amount. We look at the KPIs normally, and have our coke rates improved, has the lime consumption improved, and things like that. So it's more at a KPI level that we track things, and of course, from an overall point of view, we look at the spreads minus the conversion cost to see how can we keep improving the EBITDA. And some of the actions on the transformation program is also to do with the initiatives in marketing and sales to improve the product mix, the customer mix, reduce the delivery costs and things like that. Yeah.
Right. Understand. And just continuing a bit on that. So based on the sustenance capex, what is you had earlier given a number at what sort of spreads Europe remains cash neutral at the current costs. What number would that be?
Spread of 230.
Yeah.
I think the spread of euro 230 per ton is where
230 to 240 is a level at which we think we can be cash neutral.
Okay. And just one last question on the capex portion. What sort of the balance capex is left for KPO as of now? So once you had stopped last year, what is the balance left to complete the pellet, CRM and KPO2?
So overall, out of 23,000 crores, we have spent about 5,000 crores so far, and balance is left. And the cold rolling mill and pellet plant together will be about 6,000 crores, 6,000 odd crores, and I think some of that is already spent. Yeah.
Okay. Understand. Thanks a lot, sir.
Yeah.
Thank you. We'll take one last question from the line of Dhaval Doshi from Pinpoint Asset Management. Please go ahead.
Thank you, sir. My question has been answered. Congratulations on the good set of numbers and all the best.
Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the conference over to Ms. Samita Shah for closing comments.
Thank you very much, everybody, for your questions, and hope you found this call interesting. Look forward to connecting with you again for the next quarter. Thank you. Bye.
Thank you.
Thank you.
Thank you. On behalf of Tata Steel Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.